In this video, I'm going to show you 12 ways to legally pay less tax to help you save thousands of dollars every year. And with tax time coming soon, these tips will help you maximize your tax return for this year and plan better for next year. Let's get straight into it. Taking advantage of tax rates. The first way to save tax is to use Australia's progressive tax system to your advantage. In Australia, the more you earn, the higher the tax rate you pay. Your taxable income falls into different brackets and the percentage increases along with your earnings. If you invest in shares, the tax you pay on dividends and capital gains depends on your tax bracket. So here's a tax strategy. If you're married or have a long-term partner, consider investing under the name of the partner with a lower income. This way, the tax on your shares will be calculated at a lower rate. For example, suppose you sold some shares for a profit of $5,000 and your overall income exceeds $120,000, which places you in the fourth tax bracket. You'd be charged 37% plus a 2% Medicare levy on that $5,000. However, if your spouse works part-time and earns $35,000 per year, they fall under the second tax bracket. If their shares were in their name, they would only pay 19% plus a 2% Medicare levy, which is a significantly lower rate. Another way you can take advantage is through the new FY25 tax rate. The Australian government has announced changes to individual income tax rates starting in FY25. In the previous example, we used the current FY24 tax rate. Starting from FY25, so that's from July 2024, there will be a new tax rate. The tax rate for the second and third brackets will decrease and the thresholds will increase. The thresholds for the fourth and fifth brackets will also increase. This change will benefit most Australians as they will retain more of their income. So you're already saving on tax without doing anything. You can go onto the ATO website where they will show you a number of deductions you can claim in your tax return this year. I'll now go through some of the most popular ones, beginning with work from home deductions. According to the ABS website, 37% of Australians continued to work from home last year. And if you're one of them, you may be able to claim some deductions. So to be eligible to claim the deductions, you need to be actually working from home to fulfill your employment duties, and not just carrying out minimal tasks. You also need to incur some additional running expenses as a result of working from home. And you need to have records to show you incurred these expenses. There are two methods you can use to calculate your deductions. The first is the revised fixed rate method, which allows you to claim 67 cents on every hour you spend working from home in the current financial year. This includes the additional running expenses you incur for the following: home and mobile internet or data expenses, mobile and home phone usage expenses, electricity and gas, stationery and computer consumables. Please note, if you're using this method, you can't claim a separate deduction for these expenses elsewhere or you would be double dipping. I'll leave a link to this page where you can scroll down and see how to calculate the deductions in greater detail with some worked examples. The second method is the actual cost method, where you work out your deduction by calculating the actual additional expenses you incur when working from home. This includes expenses you incur for all these things on screen. Please go through them carefully and see which ones apply to you. If some of these items are for both private and work purposes, you need to apportion your deduction on a fair and reasonable basis. You can only claim the work-related portion as a deduction. I heard the ATO is cracking down on work-from-home deductions this year, so please make sure you do your calculations correctly. Again, I'll leave a link to this page where you can see some of the worked examples on how to calculate these deductions. Motor vehicle deductions. The next way to save tax is to claim motor vehicle deductions. If you use your own car for work-related purposes, you may be able to claim expenses such as fuel, repairs and maintenance, and overall depreciation of your vehicle. Please note, unfortunately, this does not include driving to and from your workplace. However, you can claim for trips made from your workplace to meet a client, attend work-related meetings, deliver or collect items, or travel between two or more separate workplaces. There are two methods to calculate deductions for car expenses. The first method is the cents per kilometer method. Here you can claim 85 cents per kilometer for all your car travel during the financial year. This method allows you to claim up to 5,000 work-related kilometers per car, which covers the decline in value, registration, insurance, maintenance, repairs, and fuel costs. To use this method, you should keep a record of your trips either in a diary or through the My Deductions tool on the ATO app. A worked example is provided here to help you calculate your deduction for the financial year. Please note that the cents per kilometer rate may change every year, so please ensure you check the current rate if you're watching this in the future. The second method is the logbook method. With this method, you must keep a logbook recording your work-related trips for a continuous period of at least 12 weeks. This logbook is valid for up to 5 years. You will also need to keep receipts of all your car expenses for the year. Once again, this page explains how to calculate your deduction using a logbook in more detail. All links are provided in the description. So which one is better? Well, the first method is simpler, but will it give you a better refund? Who knows? You can choose the method that works best for you, or you can calculate both and choose the one that provides a better refund. By the way, if you don't own a vehicle, you can still make similar claims for taxis, ride shares, and public transport expenses incurred for work-related travel. Other work-related deductions. As you can see on screen, you can claim many other deductions if they're work-related or help generate income. Let's check out tools, computers, and other items used for work. The cost of tools and equipment such as hand and power tools can be claimed. So if you're a tradie who owns these tools for work, this is basically your bread and butter. Please make sure to claim these. Other claimable items include calculators, cameras, musical instruments, safety equipment, computers, bags, stationery, and office equipment. For a more detailed breakdown of these items, you can visit this page on the ATO website and select the deductions that best apply to you. However, please avoid overlapping and double dipping your deductions. For example, you may have already claimed computer and stationery expenses in your work from home section. Claiming them twice may get you in trouble with the ATO. There are many more deductions you can claim, such as self-education, membership fees, personal grooming, gifts, and donations. The ATO even provides occupation and industry-specific guides detailing what you can claim. Who knows, you might even discover some claimable items you didn't even know about. For example, these are all the things a cleaner can claim. Did you know if you receive an overtime meal allowance from your work, you could claim the cost of the meal you buy and eat when working overtime? Therefore, you should review these pages thoroughly as they are packed with valuable information. You can claim up to $300 of these items without a receipt. However, if you exceed $300, you'll need to provide a receipt or tax invoice for all the items. If you anticipate having a lot of deductions for the year, consider downloading the ATO app and using the My Deductions tool to store your records. Many people fail to store their receipts because they're too lazy at the time, which leads to panic and stress during tax time. Trust me, I know, I used to be one of these people. Other people forget they bought the item in the first place and miss out on potential deductions. To avoid this, take a picture of the tax invoice straight away for an item you buy during the year and save it in the My Deductions app. Doing this will make tax time way easier for you. All you need to do during tax time is open the app and all your deduction receipts will be ready for you. Happy days! Capital gains tax strategy. The next way to reduce tax is understanding how to use capital gains tax rules to your advantage. Capital gains tax is a tax you pay when you sell an asset that has increased in value. In Australia, if you hold an asset for more than 12 months, you receive a 50% capital gains discount when you sell for a profit. This applies to shares, investment properties, and even cryptocurrencies. For example, if you purchase 10 shares of Commonwealth Bank at $100 each, totaling $1,000, and a year later the shares increase to $120 each, making them worth $1,200. If you decide to sell all 10 shares, your capital gains would be $200. However, if you hold onto the shares for over 12 months, you can get a 50% discount, reducing your capital gains tax to $100. Another strategy is to lock in your capital losses to offset your capital gains. In Australia, if you sell an asset at a loss, you make a capital loss. While you cannot reduce your taxable income with this loss, you can offset any capital gains you have. For example, if you also sold some BHP shares at a $50 loss, in addition to the $100 capital gains from your Commonwealth shares, you could offset the $100 gain with the $50 loss, reducing the total capital gains to $50. Some investors sell shares at a loss before July to lock in the capital losses, especially if they anticipate some large capital gains. This strategy is known as tax loss harvesting, and it can reduce your overall tax liability if used correctly. However, please don't try to outsmart the ATO. Some of you may be thinking, what if I just sell some shares in June to lock in the loss and rebuy the same shares in July? I mean, it's a great idea in theory, right? One small problem. This is called a wash sale, and it is illegal according to the ATO. You can't sell shares to lock in a loss and rebuy them in a short period of time, especially with a purpose to get a tax benefit. However, you can sell some shares then buy some similar shares. For example, if you want to sell some Woolworths shares to lock in a loss, you could buy some Coles shares to replace them if you still want exposure to retail. It's essential to know how to legally apply these strategies to save tax. Please note these strategies are not appropriate for everyone, so please read through the rules to ensure they are applicable to you. By the way, if you're looking to start investing in shares this year, and you're on the hunt for a good Aussie online broker, then check out Moomoo. They are currently the online broker I'm using to invest in both Aussie and US stocks. The great thing about Moomoo is that they tick off all the boxes I look for in an Australian broker. This includes chess sponsorship, low brokerage fees for both Aussie and US stocks, and they have a powerful built-in researching tool in their app that allows me to try to find the next Nvidia stock. And they are currently offering some nice sign-up bonuses for new users. Right now, if you sign up using the link in the description, you will receive up to 10 free random stocks, $2,000 brokerage free cards for both Aussie and US stocks for 30 days, which basically means your brokerage fees are covered for the first 30 days. And you'll receive 6.8% annualized interest on your uninvested cash for up to $100,000 for 180 days. In addition, the Moomoo app provides numerous free learning guides on investing in the stock market, making it ideal for beginners. However, please note terms and conditions do apply, so make sure you check it out before proceeding. I'm not sure how long this offer will last, so if you're interested, use the link below to sign up and claim all the free rewards on screen. The sign up process is very quick and should only take a few minutes. Make extra super contributions. The next way to save tax is to make extra payments into your superannuation account. Each time you receive your salary, your employer is required to contribute approximately 11% of your earnings into your super account. Any concessional contributions you make to your super are taxed at a rate of 15%, which is typically lower than most people's marginal tax rate. Given that most Australians fall within the third tax bracket, making additional payments into your super can result in significant tax savings. As of July 2024, the new annual concessional contribution cap will be $30,000. This means that you can make additional contributions up to $30,000 per year and still benefit from the lower 15% tax rate. Please note that the minimum super contribution made by your employer is included in this $30,000 cap. So it's important to calculate your numbers carefully to avoid going over the cap. If you have unused cap amounts from previous years, you may be able to increase your contribution caps in later years. Please note that unused cap amounts are available for 5 years and expire after this period. The simplest way to make concessional contributions is through salary sacrifice. You can arrange this by having a discussion with your employer, typically someone in payroll, and inform them that you would like to contribute a portion of your pre-tax salary to your super fund. Your super fund invests in similar assets as those outside of super, like ETFs that track Australian and international shares. Therefore, if you're considering investing outside your super anyway, salary sacrifice may be a suitable option. If you're interested, I have a more detailed video on salary sacrifice, which I'll link down below. Spouse super contribution. You can also make spouse super contributions to save on tax. This is a good way to top up your spouse's super and save some tax at the same time. If your spouse's income is less than $40,000, you could claim the maximum tax offset of $540 by contributing $3,000 to their super. Contributions made to your spouse's super are considered unconcessional, meaning they won't affect the $30,000 concessional contribution cap. For more information, including eligibility conditions, please refer to this page for more information. Debt recycling. The next way to save tax is to debt recycle. Debt recycling works by making extra repayments into your non-tax deductible home loan and then drawing money back out to invest. When the money is taken out of debt and used to invest into something like shares, because the new purpose of the borrowing is to invest, the interest payments on this debt becomes tax deductible. In Australia, if you borrow money to invest, the interest rate you pay to borrow the money is tax deductible. This strategy can help homeowners with a mortgage who are looking to pay down their mortgage, invest on the side, and save tax at the same time. Here's a quick example. Let's say you've saved $50K in your offset account for the purpose of investing in dividend shares. If you directly use this $50K to invest, it won't be tax deductible. But if you have a home loan, let's say $500K, and you use the entire $50K to repay some of the loan, and then immediately redraw it, this $50K is now considered borrowed money. If you then invest this $50K into dividend shares, this $50K portion of the loan becomes tax deductible. I have a more detailed video about this topic, which I'll link down below if you're interested in learning more. However, with this strategy, you need to make sure you set up everything correctly. You don't want to start mixing up the loans. If you're interested in debt recycling, I would recommend you go see a tax accountant to ensure you set it up correctly because it can be a bit complicated. Negative gearing. The next way to reduce tax is to utilize negative gearing when possible. Negative gearing occurs when the expenses associated with an asset is greater than the income from that asset. The resulting loss can be used to lower the investor's taxable income, providing a tax benefit. Typically in Australia, negative gearing applies to an investment property. For example, Bailey here earns $100,000 from his job. He also has a rental property that generated $20,000 in rental income this financial year. But it incurred $30,000 in expenses, including mortgage interest, maintenance costs, depreciation, insurance, and other related costs. Therefore, the investment property has a $10,000 loss for the year. This $10,000 loss is deducted from Bailey's salary of $100,000, reducing his taxable income to $90,000. Therefore, Bailey ends up paying tax on $90,000 instead of $100,000, which saves him a significant amount of tax. While negative gearing continues to be a common investment strategy in Australia, it's important to consider the risks and stay updated on any law changes that could affect the strategy's effectiveness. With ongoing speculation that the government may abolish it, if you're watching this in the future, please double check to see if negative gearing is still available. And quick disclaimer, I am not a financial advisor and this is not financial advice. Some of the tips and strategies in this video may not apply to you, so please do your own research to ensure you know what you are claiming. If you are not sure or have a complicated tax return, then please go see a professional. Having said all that, let's move on. Get private health insurance. The next way to save on tax is by signing up for private health insurance. In Australia, most people are charged a 2% Medicare levy. If you earn over $93K as a single person or $186K as a family, an additional 1% Medicare levy surcharge is applied. This surcharge may even increase if your income exceeds these thresholds. However, having an appropriate level of private hospital cover can help you avoid this surcharge completely. In fact, it's often more affordable to pay for basic private hospital insurance than to pay the extra 1% surcharge. If your income is above these thresholds, I would strongly recommend you consult with several health insurance providers to find the right coverage for you. Instant asset write-off. The next way to save tax is to use the instant asset write-off rule. If you have a small business that turns over less than $10 million, this rule allows for the immediate deduction of the full cost of eligible assets. These assets must cost less than $20,000 and be first used or ready for use between 1st of July 2023 and 30th of July 2025. The $20,000 threshold applies per asset, allowing small businesses to write off multiple assets instantly. This rule has been in effect since 1st of July 2023, and the good news is they have announced that they will extend it for another 12 months. So that's until 30th of June 2025. So this is great news for small businesses. If you're watching after that date, please make sure you check whether the rule has been extended further. See a tax accountant. The next way to save tax is to go see a registered tax accountant. A good tax accountant could be worth their weight in gold, especially if you have a complex tax return due to owning a business or multiple investments and deductions. In my opinion, there are 3 reasons to consider hiring a tax accountant. 1. They possess expert knowledge and stay updated on tax laws. Australian tax laws are complex and frequently change. Accountants stay current with these changes to ensure compliance and optimal tax planning. They are aware of all the legal loopholes and methods to maximize your tax return. 2. They provide a personalized tax strategy tailored to your needs. The tips in this video are generic and may not apply to everyone. A tax accountant, however, will assess your financial situation and develop a strategy to optimize your tax savings. They can identify all possible deductions you're eligible for, including the ones you might miss. And 3. They save you time and reduce stress. If your tax return is complicated, it's best to let a professional handle it for you. This allows you to focus on other things like spending time with your family or earning more money. You're not just paying to reduce tax, but also for peace of mind knowing your tax return will be efficient and compliant. And remember, the fee you pay a tax accountant to help with your taxes is generally tax deductible. The First Home Super Saver Scheme. Alright, I know I said 12 ways, but consider this one a bonus because it's too good to leave out. The First Home Super Saver Scheme allows you to make extra contributions into your super fund, helping you save for your first home. I know a lot of you guys are looking to buy your first home, so this will help you save for a deposit faster, as well as saving some tax at the same time. As previously mentioned, concessional contributions are taxed at only 15%. With this scheme, you can contribute up to $15,000 per year, with a total limit of $50,000 across all years. When you're ready to buy your first home, you can contact the ATO to release your funds. They will then instruct your super fund to release your savings. This scheme is kinda similar to salary sacrifice, but you don't have to wait until preservation age to withdraw your money. To qualify, you must be at least 18 years old, have never owned property in Australia, among other things. To determine if you're eligible and learn more about the scheme, make sure you visit this page linked in the description. By the way, if you're enjoying this video or found it useful, comment the words big tax return down below so I know who you are. And if you're new around here, what are you waiting for, mate? Hit the subscribe button and join this awesome community. Also, please consider signing up to my free newsletter, Aussie Money Club, where once a week I'll send you some money tips, major news in the market, and any cool life updates from me. And if you're interested to learn how to do your tax return yourself for free online, then check out this video on screen where I provide a step-by-step guide on how to complete your tax return using my tax. And as always, thank you for watching, I appreciate you, and I'll see you in the next video.